Okay, well, hello, everybody. This is Michael Murphy with FixUS. Thank you so much for joining us today. It's great to have such a great group on from all over the country to talk about our topic today. We're going to get into our program here in a second. I am going to start off our program here just by giving a table setting of what the purpose is for today's event and a little bit of the run of show of how we're going to go about this event today. So the purpose of today's event is based on the premise that, look, we know that we've had a seriously polarized governing environment for quite some time in Washington. And as a result of that, as part of that, businesses have been increasingly looked to help step up and help solve a range of pressing societal challenges. You know, at the same time, corporations and CEOs of major corporations have acknowledged that, you know, a business's purpose should go beyond producing shareholder value and must look to the value it produces and how it engages many stakeholders, including its employees, its community, and society at large. And now, as part of that conversation that's been ongoing, there's been a lot of discussion about why that's important in this moment, maybe less so on sort of the nitty-gritty details on how you might go about doing that. So we're really thrilled that today, coinciding with this event, that FixUS has published an essay by three experts in corporate governance and politics that try to answer that question of some of the nitty-gritty details of how you can go about implementing this vision. That essay is available on our website at fixusnow.org. We'll post it in the chat here in a minute so folks can see it there as well. And so today's event, we're going to hear from those authors about this idea that we published today, as well as engage with you in discussion. So that's the purpose. We're really excited about it. A little bit of the run show on how this is going to work today. In a minute, I'm going to hand it over to Maya McGinnis to provide some opening, welcoming remarks. We will then have a presentation by our three authors of this essay, and I'll introduce them for that. We will then have a couple of panelists join our authors and respond to that, to the new idea, and then we're going to take your questions. So I really do hope that anytime during the event from now and through the presentations, feel free to start using the Q&A function on Zoom here to get in the queue. I want to make sure we get to as many of your questions as possible. So please use that Q&A feature as liberally as you'd like, and we will field as many as we can. But with that, so first in our program, I'm going to hand it over to Maya McGinnis, who's President of the Committee for Responsible Federal Budget and our co-founder of FixUS, to provide some opening remarks. Maya?
Thanks so much. Yeah, I just wanted to add my welcome to kick things off with a few thoughts. So when we're thinking about this moment, we have these twin and economic system, which is also in crisis and increasingly losing the trust of the American people. One poll found that nearly half of Americans believe capitalism does more harm than good in the world. And so for FixUS, we're focused on bringing together, I see internet is unstable on my part, so I'm hoping you can hear me. We are focused on bringing together experts and citizens to understand and address our divisions and distrust in our political and economic institutions, and to help identify different ideas to overcome these kind of stumbling blocks in the moment that we're in. We're excited today that we're going to discuss one such idea, given the dual challenges of our broken political and economic system, which is how can businesses step up in this moment and both help solve the actual problems and help restore faith and trust in our system and our major institutions. So what I like about this paper is that it attempts to put some details into the idea of stakeholder capitalism, which is an area that's been getting a lot of important attention. And there seems to be more consensus on the need for businesses to engage their stakeholders more as part of their purpose, but less so on the nuts and bolts for how they can do that. So I really hope everyone will find this event and the new paper helpful in that regard. I'm very excited to have this help fix us putting out there. We then have all different points of view to just further discussion about how these things can work. So thank you so much to our authors of the paper for putting forward their ideas, sharing them with us. And Liz for joining us, and I'm looking forward to the discussion.
Thank you, Maya. We broke up a little bit during that, but we got most of it there. So thanks, Maya. So now we will.
I have terrible Wi-Fi. So sorry.
Okay. No, we got most of it. So with that, we're going to transition over to hearing from our authors that wrote the essay that we're talking about today. And to do that, I'm going to briefly introduce the three of them and then hand it over to them. And like I said, they're going to give about a 15-minute or so overview of the essay before we bridge into a panel discussion. So let me introduce the authors of the essay now. First is Wes Bricker. So Wes is a vice chair of PricewaterhouseCoopers Assurance, and is vice chair, and and PricewaterhouseCoopers Assurance leader for the United States and Mexico. Sorry, Wes. Prior to joining PwC US, Wes served as the Securities and Exchange Commission's chief accountant beginning in 2016. He was also the principal advisor to the Commission on Accounting and Auditing Matters and led the Commission's Office of the Chief Accountant, amongst many other notable roles. So it's great for Wes to be with us in his work on this effort. Khalil Bird is with us as well. Khalil is the founder and CEO of Invest America, an advisory firm that serves the most creative financiers and builders of complex organizations and movements whose aspirations have the potential to reach and improve the lives of over 150 million American voters. And Khalil is also a big partner of ours broadly with FixUS, and it's always great to have Khalil with us. And Jamie Gamble is with us as well. Jamie is a retired corporate attorney. He was a litigation partner at Simpson, Thatcher, and Bartlett. And recently, Jamie's worked on several efforts to advocate reform of corporate governance, to empower businesses to engage in more stakeholder-driven capitalism, had several essays published on this and been profiled in the New York Times as well. And so it's just great to have all three of you with us today. So with that, we're going to hand it over to our authors. I believe, Jamie, you're going to start us off, and then we'll have Wes and Khalil follow before we get into our panel. So Jamie, I'll hand it over to you.
Thank you, Mike, and good afternoon, everyone, and thank you all for coming. I'd like to first start by thanking FixUS and thanking Mike and Maya, both for organizing this and for supporting the development of the essay that we're here to talk about today. So shareholder capitalism has been a rising topic of interest for years. Since the Business Roundtable statement in the summer of 2019, discussion has intensified, fueled by investor interest in climate change, and after 2020, by rising concern over public health, income inequality, racial injustice, democracy, and the rule of law. Most of the discussion to date has been about why stakeholder capitalism either is or isn't a good idea, or it's been about particular programs or projects that people are working on. Our essay takes a different approach. It uses a slightly different lens. It's about how companies can engage with stakeholders on macro societal issues, and about how companies can set goals and then how they can execute on those goals. And that's really the key. This is about moving from aspiration to execution. And because the paper's only been available since this morning, I'm going to do a bullet point summary of the plan that we propose. And the bullet point summary is actually in the paper. So if you want to follow along, you can do that directly. I will then briefly touch on the reasons why we think this approach can work. The essay goes into some of the key corporate governance concerns we expect many people to have about the plan that we propose. I'm not going to go into those in detail. I'm really not going to go into them at all because we want to save time for discussion of the issues that are uppermost in your minds. I'm then going to turn the discussion over to Wes, who's going to talk primarily about measurement issues, which are critical to this. And then finally, Khalil Bird will talk to us about how this type of effort fits into the larger political moment that we're in. After that, our panelists will join the discussion, and then we'll open up for questions. So the plan has 4 parts: analyze, goal set, report, and enhance. Part 1 is analyze. Corporate leadership should investigate stakeholder concerns and desires for the company to engage in the issues that they care about. Think here about surveys, town halls, polling, internal social media structures, all of the entire range of small d democracy tools for companies to investigate what their stakeholders want them to be involved in. Corporate leadership should then assess its own ideas about social engagement alongside those of the stakeholders and analyze how engagement will affect the company's operations and its long-term value creation. This is really stakeholder-informed engagement planning done exactly as any other form of business planning is done. And that's a part of the goal here. Use existing tools and skills to approach new goals. Part 2 is to goal set. So leadership here needs to develop data-informed, measurable engagement goals and milestones, and then submit the goals and milestones to shareholder debate, revision, and this is key, to a binding shareholder vote. Part 3 is reporting. The company should report annually on progress, and the reports should be public, and they should be sufficiently detailed to allow shareholders and other stakeholders to accurately judge the company's performance. This step includes building all the measurement, HR, incentive, and reporting systems necessary to meet the need. And think here about the types and extent of structures that are applied to support financial reporting. It's that kind of an effort. Shareholders should also be able to use the normal tools that exist today to enforce compliance, which are shareholder resolutions, proxy contests, and even derivative litigation. All of these, of course, subject to the limits of the business judgment rule. And then part 4 is to enhance. The company should repeat the goal setting process on a periodic basis to keep the engagement goals and milestones aligned with current priorities. That's the essence of the plan. We think the key strengths of the plan are, first, that it integrates stakeholder engagement into business operations and uses existing management tools and skills to accomplish these new tasks. And again, integrating is critical. It can't just be an add-on. It's got to actually be part of the way the business thinks about itself and functions. Second is it's executable. Any company can actually do this now. There are going to be risks. Even with shareholder approval, which is a key part of our plan, dissident shareholders can show up and start a fight. But with more companies moving this direction, we think the risk should be manageable. We think that our plan draws on the dynamism of business. Because it's a system of self-regulation rather than top-down regulation, it'll lead to differentiation. Differentiation leads to innovation, which will improve performance. And finally, the plan engages stakeholders in setting corporate purpose. That's the outline, and I'm now going to turn this over to Wes to talk more about measurement and the way this functions in practice.
Thank you very much, Jamie. And let me just echo your thanks to the FixUS team, to Maya, to Mike, and the full team. Thank you very much for accommodating us and the ideas in this paper. So in building on what, Jamie, you had just discussed, I want to focus on an important piece of our proposed plan, and which is measurement. Measurement is critical for any company to be successful in its engagement goals. And so to provide a bit of a contrast, just to start the discussion, it's helpful, I think, to draw a parallel between how companies should be achieving their engagement goals and what they've been doing to achieve their financial goals. That's something we're all very familiar with. We know financial goals very well. So let me just summarize that in a brief way with a bit of the elements of financial goals, providing context then for how we should see engagement goals. Financial goals start first with reliable measurement. Companies have systems in place to make sure their reported financials are reliable. We count on this. The systems to include internal controls and processes. It includes the oversight of an audit committee, annual audits by outside firms of financial statements. That's part of reliable measurement. But then secondly, financial goals are reflected in transparent reporting. Companies report their performances publicly and periodically through annual reports or quarterly financial statements so that stakeholders and investors can understand how things are going and provide feedback. That gets to the third point, accountability. Managers' compensation and job prospects are tied to financial performance. And poor financial performance has consequences. Positive overperformance, similarly, has consequences. Those are financial goals. And so the main idea within the paper is that we think there are common concepts that can be applied to engagement goals. We think the same set of systems used for achieving financial results should be used to achieve engagement goals approved by shareholders, as Jamie talked about. Here, companies still have a long way to go to have a system in place to produce high quality stakeholder engagement metrics. Just in describing a bit of the baseline that we see from what we've observed, what I've observed, many companies' practices of reporting ESG or sustainability information, which is a related but different topic, generally do not have the same in place as the same system for measuring and reporting non-financial information with the same rigor as what they have for their financial reporting. For example, even if many companies have been disclosing ESG metrics for some time, those metrics typically haven't been subject to the same set of controls and processes, or the same degree of board oversight, or the same degree of external assurance. It's also rare for companies to tie management compensation and career advancement to ESG for sustainability goals. From my discussions with many CFOs, there's been a strong interest in the CFO community and among business leaders to move further toward high quality ESG disclosures and to draw upon the expertise that they have in financial measurement systems. Our plan in the paper is calling for an integrated measurement and reporting system, integrated across engagement milestones and goals, and weaving those into established internal controls and governance systems. And that means that engagement goals and intermediate milestones are essential parts of corporate strategies and operations, that they should be integrated into the same measurement and feedback systems, supported by internal audit functions, external audit functions, supported by a management information system. And then management performance should also be factored into by boards in their promotion, training, and compensation decision. The board's attention should not only be focused on the ultimate goals, but also on the intermediate progress towards those goals. That's the feedback element that Jamie talked about. Many of the investments can have very long-term horizons, as we know, such as net zero pledges or other climate change initiatives. Those tend to have 2030, 2040, 2050, some even 2060 timelines. Well, of course, we wouldn't want to wait until 2030, 40, 50, or 60 to take stock of how performance is going. So milestones can be an important way of understanding whether we're on track or whether we need to adjust. In an area that is developing, still has a lot of latitude and often lacks well-defined measurement practices, is the question of what to measure and how. What to measure is clearly important, but how to measure it is equally important. And boards and management teams should carefully select metrics that truly reflect the engagement goals that they've identified. Just to illustrate the complexity of how, there's a well-known example from Apple in the very early 1980s that came to mind as I was working through this. Apple back then was measuring individual software engineers' productivity by lines of code. They were counting lines of code as a measure of performance. They were measuring that every week. Bill Atkinson famously refactored some code that had improved efficiency by nearly 6 times, and in the process had eliminated 2,000 lines of code. His weekly performance report showed negative performance, minus 2,000. That's clearly not the objective that was needing to be communicated. So what is being measured and how it's being measured is critical to this combination, so that the measurement is consistent with the direction of corporate strategy, corporate objectives, and stakeholder expectations. Last, in deciding what to report publicly, companies need to develop and apply materiality policies. Materiality is a pervasive concept that underlies corporate reporting, has implications for the level of detail to be included in public reports. Materiality defines the nature of information for a given audience. So in summary, reliable measurement and effective governance are what companies already know how to do for financial statements. What we're proposing is that the same rigor be applied to the achievement of their stakeholder engagement goals to ensure a high degree of transparency and accountability. And now with that, KB, let me transition over to you.
Thank you. Appreciate that, Wes. Appreciate FixUS, and always honored to be on the advisory board here. So what you've heard Jamie lay out is a process by which stakeholders can rigorously engage with corporate leaders and corporations. What Wes has taken us through is why it's so crucial to be able to measure and rigorously lay out this. We're talking now to democracy reformers. We care about the health of our country, and we feel we're in an emergency. So what's in it for us? Why is it so important to talk about this through FixUS? In a survey in 2019, 90% of the respondents, this is a Just Capital survey, said they want corporations to be more active. Only half of their employees are satisfied with their engagement in society. And this is before the COVID pandemic, George Floyd's murder and the aftermath, and January 6th. The reality is that we as political reformers are a significant and important part of the stakeholder community. And while we've seen, for example, Civic Alliance and other things have been an effective down payment, we'd like to be at the table and have a consistent engagement with corporate leaders and corporations. That's what this process is about. That's why it's so important to understand it. What we're trying to work through is draw a line between the corporate leadership and the advocates, reformers, and those in the private sector who are working to fix democracy issues. And if you talk to CEOs and leadership and boards, they feel they've done a lot over the last 2 years. Citizens in many cases don't feel like they've done enough. What we're advocating for is a transparent and rigorous process to allow the two sides, those who are tasked with running the corporation and stakeholders, to be able to work through what a corporation's best and highest use is in helping to solve these problems. And one of the things that is just a given is that reformers don't understand how corporate governance works. And this is a process to help reformers cross that Rubicon. We are strongly recommending a moment of political pressure on corporations that this be a self-regulatory effort. Those companies like Walmart and others who are most committed to weaving stakeholder capitalism into their processes, and many can be named here, they are strong because they've done it themselves. We believe, or I should say I believe, that government would move too slowly, would regulate behind the curve, as opposed to groups of companies coming together, developing their engagement plans, connecting with stakeholders significantly, rolling these plans out, and over the sort of 2 to 3 year arc, reformers and others will be able to engage, and CEOs and boards will be able to meet their fiduciary obligations as they expand their mandate. Look, the most important point for the FixUS community around this is think about the idea of listening to, doing research, and developing a shared understanding of what a company should do at this particular moment. We believe that this is a significant and important down payment on democracy, little d democracy. It's a tool that is very important to us, bringing corporations closer into this fight to help improve and heal our democracy, allowing the corporate leaders and CEOs to continue to meet their fiduciary responsibilities and solving problems for citizens at this time of emergency. Where we've been suffering is that corporations have been constrained in their ability to reach out, and they have been operating in the emergency. We want that to be transparent, rigorous, systematic, and we want our reformer community to be able to engage with the senior leadership of these companies in a healthy and fruitful way. So with that, I will pass it back to Mike, who I think we'll hear from other panelists to get their thoughts on this.
Perfect. KB, Wes, Jamie, thank you all. That was really great overview. What I'm going to actually ask before I'm going to have our other panelists join in here in a second. I'll introduce them. Jamie, Wes, KB, why don't you all turn your cameras on too? So we'll just have a whole full panel here as well. And so what we'll do is I'm just going to introduce our two other panelists to come on and who are going to offer their reactions in response to this idea. So Sarah and Joanne here, I'll introduce them in a second. Turn on their cameras. Great. So let me briefly introduce both Joanne and Sarah, and then hand it to each of them in succession to offer some reactions. And then we'll get to, and then we're going to get to some Q&A because we already got some Q&A building up. So we'll get to that. So let me introduce our other panelists. So let's start with Joanne. So Joanne Joachim currently serves as an independent committee member of the Assurance Quality Advisory Committee at PwC. And she previously served as chief accountant of the Federal Reserve Board's Division of Supervision and Regulation, where she led chief accountant and advised the Federal Reserve Board of Governors on the implications of key accounting, auditing, and reporting issues. So it's great to have Joanne with us. And Sarah Bonk, who's been a partner of FixUS as well. And Sarah Bonk is a founder and CEO of Business for America, a business group dedicated to mobilizing the business community to help advance popular bipartisan political reforms and technology solutions that strengthen representative democracy. And it's great to have Sarah with us as well. Okay, so I'm going to start. Joanne, I'll let you go first, and then I'll go with Sarah before we kind of bridge into panel Q&A. So Joanne, please.
Great, thanks. It's great to be here today. The paper is very timely. Boards at companies, both big and small, are wrestling to get educated on issues related to corporate purpose, stakeholder capitalism, and how to approach ESG issues. So in terms of my reaction to the paper, I want to make 3 points. And my first point is that we can and should move the ball forward now. So the paper discusses the tension between a company working towards social values and the corporate governance system that mandates the primacy of shareholder value. My first point is that there are many issues that fall within the population of social values that will clearly impact long-term value creation for certain firms. And so all companies and all investors should, and regardless of that, all companies and all investors should be concerned about issues that impact long-term value creation for any given firm. And proper governance and risk management require that any board and management team be aware of issues, internal or external to the organization, that can impact value creation. So while many people may disagree on whether a company should work to further specific social values, everybody should agree that all companies should be focused on any issue that impacts the long-term value of a particular company. I think that's what BlackRock and others are saying when they talk about corporate purpose and ESG issues. So for example, Larry Fink at BlackRock has stated he's focused on climate issues because of the risk climate change poses on investor returns, and as well as the risk that potential policy changes, those things external to any company, that might put pressure on a company's returns. And then in August 2019, when the Business Roundtable updated its principles of corporate purpose to redefine corporate purpose, the president of the roundtable, Joshua Bolton, said it was not a demotion of long-term shareholder interests, because in the roundtable's view, the interests of all the stakeholders and shareholders align in the long run. And even Milton Friedman, in his 1970 New York Times essay, said, it may well be in the long run interest of a corporation that is a major employer in a small community to devote resources to providing amenities to that community, indicating that those kinds of activities, investing in a community, are well within the shareholder mandate of value creation. So companies can and should move the ball forward on ESG or social values that impact the long-term value of a company. And companies don't need to wait until the debate between corporate purpose and the primacy of shareholder profit is resolved. And I think the paper offers a great framework on how to move forward. My second point is that it takes time to see results. These types of commitments, ESG-oriented commitments, are essentially the kinds of programs that show up as large, multi-year, company-wide strategic priorities. And the success of these initiatives takes the efforts of the board all the way down to the most junior employees. So large strategic priorities or change management initiatives involve many things like commitment from senior management, interdepartment and interdisciplinary planning teams, interdepartment and interdisciplinary execution teams, employee engagement at all levels, goal setting, milestone setting, incorporation into strategies, ongoing communication, identification of metrics and reporting. Like these kinds of programs usually are massive, and they involve all areas of a company, and they take a long time just simply to set up, much less to execute on. The metrics chosen will likely require data not previously used for reporting purposes. Wes talked about this, and therefore new processes and internal controls will likely be required. So again, it takes a long time to see meaningful change and to see meaningful results. And if we think about our own companies, maybe different strategic initiatives that our companies have embarked on, maybe it related to diversity or unconscious bias or technology upskilling. You know, think about how long it took to see real success, if you have even seen real success to date. I came across a study that tested whether corporations carried through on their roundtable pledges by looking at the results post-pledge. So the study looked at the pledges made in August of 2019, those companies that made pledges, and assessed activities and operations as of June 20. Well, that's only 10 months. Only 10 months had passed in between making a pledge and looking to see whether there were meaningful results. And the study did not find a significant change or meaningful results. But frankly, that's not surprising to me. I think those kinds of initiatives don't usually generate real change in less than a year. For diversity efforts, yes, you may be able to see a change in the percentage of new hires that fall into a particular category, but you won't see change across an entire company at all levels in that short period of time. And my third point builds on my second, which is if it takes a long time to see results for these major strategic initiatives, what is the best way to ensure progress and then eventual success? As the paper mentions, and as Wes has mentioned, goal setting and reporting is really vital. So transparent and informative reporting, and for our purposes here, third-party assurance, is vital because it provides accountability and credibility. And we have a very mature financial reporting and third-party assurance process. It's the foundation for our capital markets, and it has ensured quality of data for investors assessing risk and making capital allocation decisions. And that should be our model here. So again, reporting will be essential for these long-term projects. And the metrics will show progress or show results. And as had been mentioned earlier, sometimes those results will take a long time. So maybe you've heard from a manager at some point in your career, I don't want to hear how hard you're working, I want to see results. Well, for these long-term projects, you may not see results in a year, even 2 years. And so you also need to show how hard you're working. You know, you need to show progress along the way. So quarterly, periodic, annual reporting is essential because it allows a company to show progress. And then even if a company is not progressing on a project as desired, reporting really generates a lot of credibility with all stakeholders, just simply the fact that you're being transparent and honest about lack of progress. And it also allows for accountability. And regarding accountability, as the paper notes, and as Wes has said, many of the climate change commitments will outlive the expected tenure of senior management. So probably none of the CEOs making commitments for net zero by 2050 will actually be around in 2050. And therefore, a company will need to have metrics and then appropriate and relevant incentives in its personnel management process and its compensation plans. And those incentives will need to be based on the metrics that are kind of coming through the reporting. Through that, a company can drive accountability and success for these important long-term commitments. And thanks for the opportunity to comment on the paper.
Thanks, Joanne. It was great. I appreciate that. Turn it over to Sarah Bonk. Sarah, please.
Thanks, Mike. Thanks, Maya. Thanks to everybody who's taking part in the conversation. I was excited to read the paper and offer some comments. I think they're very complementary to what we just heard from Joanne. So similar thing, I'm so excited to talk about how. You know, I think most of us here have moved past debating shareholder primacy And we believe businesses really do have a greater calling than profit alone and feel a sense of urgency. So this really is a timely conversation. And I founded Business for America. It was because, like everyone here, I believe that the public interest and the business interest are aligned on so many issues. In our case, it really is about the focus on democracy exclusively. We mobilize businesses to take action on strengthening democracy. And those businesses have a responsibility to their stakeholders, of course, their employees, their customers, their communities where they operate. And, when businesses are asking us, what does it mean to take a stand to help strengthen democracy? We're talking about increasing civic engagement, ensuring election integrity, and combating polarization, really to advocate for the rule of law and help strengthen these essential institutions that we need for our society and for our businesses. So what we're really looking at is stakeholder capitalism in action. Looking back to 2020, just to kind of crystallize some of what you've read in the paper and how we've seen that realized in the world of democracy reform, we were helping businesses who wanted to be sure their employees could get to the polls and making sure they gave them time off from work. They were asking their employees to be poll workers. They even contributed PPE and other supplies when there were shortages. Election officials were unable to meet all the needs out there. So in 2021, we're coordinating now. What do you do in a non-election year? Well, we see businesses stepping up to advocate for political reform. And we see them also thinking about their corporate spending in ways that we haven't seen in the past. So really are in a changing world when it comes to stakeholder capitalism and democracy. An example I want to use for how some of these House steps can be put into action in the work that we're doing. In particular, we're organizing a business letter to Congress in support of passage of the John Lewis Voting Rights Advancement Act. And this really is all these aligned interests that you read about in the paper. Businesses are signing on because of their values. They care about racial equity. They care about inclusion in the election. And they're doing it because they care about their employees. They care about their communities. They care about the health of our democracy. And they understand how essential that is to their businesses and the future of our society, the future of our economy. So really, this has been, for us, a really fun example of how all the pieces fit together when it comes to stakeholder capitalism. So for anybody who's watching, one of the things that I often thought about while reading the paper and hearing these comments, for those thinking about how, there's a lot to it. Obviously, when thinking about all the metrics and the measurement and the reporting and the accountability, but you don't have to have it all figured out before you do something. There are opportunities to take action today. You don't have to have the entire plan laid out before you get going. So I've been in those conversations with business leaders and think tanks, and they want to make sure all the pieces are in place. The government affairs knows what they're doing. The corporate PAC plans are lined up before they take action. But when it comes to this, using the example of our letter on the Voting Rights Advancement Act, we have Fortune 500 companies. Right now we haven't even gone public, and we've got companies worth over 450 billion in annual revenue signing on to this letter. And some of them froze their corporate PAC spending, and they still haven't figured out exactly what they're going to do yet. But they aren't letting that stop them from taking action. They understand that there are problems that their stakeholders are facing now. There are critical issues and urgent opportunities for businesses to lean in right now, and they can start using their influence for good. And they're also not waiting until they're 100% confident that they can draw the relationship between the ROI and the impact and the action, doing things that make sense and that are aligned with their values. So the lesson here is, take action when you know there's a fit with your values and that it's going to be good for your stakeholders. Don't wait until you have it all figured out. And my final thought is around seeing stakeholder engagement. When we think about the how and the process, it can be very technocratic. There's a lot of details to making all of this work. And for those of us who like to geek out on this stuff, it's pretty fun, but it can be also a little dry. So I would encourage folks to think about stakeholder engagement as an opportunity for innovation and an opportunity for competitive advantage. And I also have an Apple story because I worked there for almost 15 years. And I remember in particular one quarterly results meeting. It was 2014. And a shareholder activist from a think tank came and he spoke up. This is when, a lot of these things happen in person. And he was pushing Apple, and the think tank was pushing Apple to disclose the cost of its sustainability programs and the impact that those programs had on the company's earning power. And in that meeting, he asked Cook directly to commit to only pursuing actions that would be immediately profitable to Apple. And Cook responded, and he didn't do it in the most friendly and happy manner, but he responded by saying, Apple does things because there are some things that we do are because they are right and just, and not just about ROI. And I looked up the quote because it was pretty good. And he said, if you want me to do things only for ROI reasons, you should get out of this stock. And I was really proud to be an employee of Apple and real proud of Tim at that moment. Not everything has a clear ROI, not everything has a clear metric, and that's okay. The point here is that part of the how of stakeholder capitalism is about having moral clarity and leadership, demonstrating leadership and having courage to take on your responsibility to our society, to our country, really to the future of humanity, to shape a democracy that works for all of us, and to allow us to move forward together as citizens, as humans on the planet and floating on a rock in space. We have a lot of work to do to make sure we can have that shared future that's going to be good for all of us. And really glad that we're taking these steps today to talk about the pragmatic aspects of what that looks like for corporations that want to engage on these issues.
Great.
So thank you.
Thank you, Sarah. Thank you, Sarah and Joanne. It was great. Okay, I'm looking at the clock. We're a little bit behind. We have about 15 minutes left. Maybe we can go a couple minutes over. We got a lot of questions, though, we want to get to. Okay, so what I'm going to try and do, instead of, I was going to try to have everyone respond to some of what Joanne and Sarah were saying, but let's go into the questions. I want to start to get some of these questions in here. There's several, obviously, panels, so I'm going to try and direct them as best I can. I'll ask you all to try to keep them succinct so we can get to as many as we can here. And there's kind of a mix as I'm going through it of ones that are very direct to the ideas in the paper, as well as some others that certainly we can get, I think, Joanne and Sarah in on here too. So let me start with this and I'll try and direct some of these. All right, so Greg asks, to the extent that stakeholder capitalism requires change in state corporation laws, right? Do you see a path to create a, quote, race to the top among states as opposed to a race to the bottom? Jamie, maybe I was thinking maybe you want to start with that, and maybe Wes jump in here too. Jamie, you want to start there?
I think, yes, a couple things. The first is the way we look at the plan as it's laid out. Any company can start it now without having changes to state and corporation laws. As I said, there's some risk there. Dissident shareholders are going to be around as long as the legislation hasn't yet gotten there. I think discussing the pathways is not something I think we could possibly do here in anything like a concise fashion. So I think the politics will be hard, as anybody can see here, unless I think the one thing that will make politics easier, and I think we would, at least I certainly know, KB and Wes and I have talked about this, the pathway here is through companies beginning adoption. As companies do this successfully and start to build best practice lists, what will happen is those best practices will then proliferate through industries, and the companies that are leaders will then become advocates at the regulatory level for change, so that the practices become policies because those practices have been tested, and they have champions in the private sector who will then say, we're observing these things, we think they are best practices, and we don't want free riders in our industry. So we now want the policy to require everyone in our industry to follow what we've identified as the right way to do this. That's, I think, the most likely way you're going to get there, because it's going to put business behind legislative change. And I think if business is on the opposite side of legislative change, it's going to be virtually impossible to do this.
Wes, I'll let you jump in, or KB, anyone wants to respond to that. Otherwise, we'll just keep going to questions.
Great answer.
Cool. Yeah, I think it's hard to improve on that.
Good. Let's. Here's a direct question for Joanne. Someone asked, Mike asked, Joanne, how can you develop criteria to ensure that the third party chosen for accountability is truly, quote, independent? Please comment and consider this role would be approved at a shareholder meeting with a vote. Any reaction to that, Joanne?
So, I think the question of independence is, it's a good question. It's something that from an audit firm's perspective on traditional financial reporting, there are clear regulations. Certainly the banking agencies have some independence regulations. The SEC has independence regulations. And so I think that's what I would look to in terms of initially looking at independence. So audit firms are in the business of providing some assurance on some of the ESG topics. When it comes to independence for other maybe for a broader range of companies on a broader range of information, I do think that conflicts of interest and independence is a big issue. I think that's something that is worth having a lot of transparency around. And I think certainly transparency and that going to shareholder, for shareholder disclosure would be key. I don't know if others have any kind of thoughts on that.
Yeah, I would just underscore a point which is so important, that independence is the objectivity, the impartiality, an outside-in perspective, which then enables users of assurance to have more confidence in the quality of the information. So those standards, exactly as Joanne had described, have been honed over time to work well in the financial context. They can be applied here.
Great. All right, KB, Sarah, I'm going to come to you both on this one. I'm going to combine two questions. They're kind of more about just more the political communication sort of side of this, frankly. Kimberly asks, I'm interested in hearing more about how stakeholder capitalism can be best communicated as a democracy component in a non-political way. And then I'll add another one that's flip of this a little bit. Naomi asks, what are the arguments against stakeholder capitalism? How do you overcome that, right? She says, all panelists seem to agree, but it would be helpful to see that discussion. So KB, then maybe Sarah, I want to combine both of these kind of more political communication type questions here.
Look, what you're hearing today is the translation of a very difficult reality that CEOs and corporate leaders live, and the desires of stakeholders like reformers and citizens. And what we are advocating in grounding this in the engagement process is that there is a transparent, coherent, normal process by which stakeholders, beyond just whether they keep the stock or they buy the products, can actually engage. And I go back to the point that reformers and people who are focused on moving legislation in Washington on HR1 or state level change on gerrymandering do not understand corporate governance. And it is both confusing and unsatisfying to understand that CEOs and boards, for them, it is illegal for them to reallocate investor capital or revenue towards some of these particular issues that are emergencies. Sarah began to crystallize it. What we want to encourage is for corporate leaders to have confidence and not be reactive as they're dealing with the emergencies of the moment. But also, we make a strong argument that each company has its strength. One company will be strong in education. Another will be in criminal justice reform. Another with ESG. One size does not fit all. The idea of the best practice that Jamie talked about, corporations being the megaphone to be able to articulate through their investor communication networks, through earned media networks, through more public networks, and then having an administration like this one articulate and point to those opportunities. It can't just be about the Defense Production Act, and we got really going because of that. What we're talking about is the ability to meet the emergency, but also to have a rigorous long-term plan where communication is a significant part of that. And I guess I'll pass it to Sarah if she has additional thoughts.
Khalil, I thought that was fantastic what you said. And, the capitalism is shifting. We'd like to think we've won this argument about what the future of capitalism needs to be, but I think it will be continuing to evolve. For those of us who believe in market-driven economies and the power of enterprise, innovation, and entrepreneurship to create a better future. We have work to do. And it's wonderful that there are leading companies on this, but the argument is ongoing. And we were asked to talk about objections to stakeholder capitalism. And that would be not even just an entire another webinar, but that is a decades-long argument. And I think that anybody listening does want to know more about that. I suggest reading up on the Chicago School and Friedman's thoughts. You really ought to go back even to Adam Smith. But there's lots of great resources online and understanding why stakeholder capitalism over shareholder capitalism, and the idea of getting now into the brass tacks of how we make this happen through leadership, figuring out a set of processes, metrics, systems. And it is very interesting to think about then, through businesses leadership and through corporate private public partnerships, how more of those norms could actually be written into the systems of law, corporate law and others, to help ensure we have an economy that is more just. Is going to be a lot of work. And I think, though, that the conversation, the steps we've outlined here today are essential, but it's going to require more. So I think, if anything, we should think about getting back together in 6 months with the next set of steps.
30 seconds on objections. The objections to stakeholder capitalism have been written in granite for more than 100 years. Water wears down granite. In this particular case, the water is a generational change that is happening, putting pressure on leadership. So leadership is feeling pressure from outside, from consumers, from their employees. And so, as Joanne and Wes have talked about, instead of being reactive, this is about being proactive and measuring and creating an engagement process. So I agree with Sarah. This is a good opportunity to call for another meeting.
Bring the group back together in a few months. Wes, I'm going to come to you on a couple of these questions. I'm trying to combine some of these here too, so we can get through more. John asked, are there current companies, right, that are doing this very well, making decisions based upon this process? So that's one question, but I'll wrap in a couple of others here too, because there's a couple of questions within that are kind of trying to get at the size question of companies, right, and how they might do this, right? So Bob asked, could you address the corporate size context? It seems that if implemented, only large corporations will have the leadership and resources to engage stakeholders in this effort, et cetera. So Wes, maybe you could take that. Examples of good ones, maybe think about the size context here too.
Yeah, both are terrific questions. And so in addressing each of them, companies are doing this, but not consistently. We think there's a path for driving more consistency and scale across the system. That's why we developed the essay. We think there's a pressing need and that it's urgent to get started. So what are companies doing? Some companies are disclosing publicly their commitments. I mentioned a net zero commitment, but you can also think about diversity, equity, and inclusion commitments. Disclosures are being made, but those disclosures and metrics are in need of continued focus. And that's why I made some of the comments around ESG. There's a good start, but there's more work to do. On the size question, this works for large companies as well as small. This doesn't take large, sophisticated, complex companies to pull off. Small companies can get started because it starts with a fundamental of engagement. Engagement to understand what's important to stakeholders and then translating it into the work of a company. And that's for all companies to do. So those are 2 points, Mike, terrific questions. And as we see in practice, companies are getting engaged and the time is now.
That's great. Jamie, I'll come to you. This person asked direct question of you, I think during your remarks. So Bruce asks, okay, of the 30 largest employers in the US, 29 of those 30 have made concrete commitments to reduce in science-based terms the most significant greenhouse gas magnifiers, right? They're reported annually, as you were asking. is it that firms are moving in your desired direction, or do you believe that this is not happening in the firms that are large enough to shape a response on regulation to carbon? I don't know if you follow that question there, Jamie, but they asked you directly. I'll let you take that.
So I think, and Wes will have really good feedback on this as well. So what I would say is that climate is the leading edge of this project, the project of stakeholder capitalism. It's something that has been on the table for a long time. I think at least among business leaders and people who are making genuine decisions about action, debate over whether it's real and whether it needs to be addressed is long past. People are clearly acting on it. I think there's significant pressure from major institutional investors in this direction. And while there is some debate about how intensely and some of this statements of investors are being applied in practice, it's there and it's very real. I think the big thing I would differentiate, though, and Wes and all of us have talked a good deal about accountability, is that making commitments is incredibly important. And I'm glad that many large companies are making these commitments, and I applaud them for doing so. But in the current environment in which we're structuring these things, they're not accountable for those. They're accountable sort of in the large historical sense. But they're not accountable directly to stockholders, not accountable to other groups of stakeholders, not accountable to any government entity. They're simply saying, we plan to do this and we'll get there. And so part of what we're talking about here is the basic idea that if you really want, whether it's climate or other stakeholder value goals, to become truly a part of the DNA of business, you're going to have to build in the same kind of reporting and accountability structures that exist for financial metrics today. So I think that would be the differentiation I would make. I think climate is the forefront of this. I think much good work is being done. It still, generally speaking, lacks accountability.
I would just build on that and say, what I see, our real thrust here is that we see this as being good for business. This doesn't erode business. This is good for business. But in being good for business, it requires more collective action and response and consistency to get the coordination, to get the best practices going that Jamie talked about, to get the reforms focus that KB talked about. That requires more conversation and more coordination, and coordination around the execution to really achieve what's possible.
My experience advising business leaders is that they have to concentrate on quarter-to-quarter goals. They have to concentrate on things that are tied to their compensation, that are tied to their promotion, that widen their aperture. It's very difficult to take your eyes off of those things. The engagement process is a way to have stakeholders come in and draw that line between what we're talking about in reform and how a corporate leader is graded on a quarter-by-quarter, year-by-year basis. And when you tie these goals that Sarah started to double dip into or double click into to their compensation, as opposed to just the press release and the branding position of the company, we believe over time, over the period that Joanne talked about, you can see significant changes.
Okay, we're out of time. We have like a lot more questions to get to. We're going to figure out a way to facilitate more questions offline or something, and then maybe the idea of bring the group back together in a few months. But I'm just going to wrap it up here, as I know we're running a little long. Just by saying thank you to everybody for joining today. We had a really good group and a lot of questions. Sorry we didn't get to all of them, but thank you all for joining. Thank you to our authors and to Joanne and Sarah for joining and reacting to this as well. As I said at the outset, we're excited to put forward this idea as part of FixUS. Because I believe it was Joanne who said in her remarks, time is right for discussions like this for a lot of reasons. And so we're really thrilled to have hosted this event and to be with all of you. So thank you all. Hope everyone has a nice rest of their day. Take care.
Thank you.
Thanks to everybody who listened.
Thank you, FixUS.
Thank you.
Thank you so much.
Thank you.